Cape Coral was the Florida boomtown everyone envied, until its real estate market detonated, leaving even the governor reeling. Home prices shot up 83% in just 2 years, fueled by bidding wars and cash-flush newcomers. But as interest rates doubled, taxes soared, and insurance became unobtainable, the crash arrived with shocking speed. Values tumbled 11%, over 8% of mortgages went underwater, and Citizens Insurance found itself holding billions in hurricane risk. Now, Governor DeSantis scrambles as the fallout threatens not just Cape Coral, but every homeowner in the state. How did paradise flip to panic so fast? And what pushed Florida's highest office into crisis mode? The unraveling started earlier than anyone realized. Sunlight glints off the water as moving vans snake across the bridges into Cape Coral, each one packed with furniture, hopes, and the promise of a new start. In 2021, the city became the epicenter of America's migration wave. By December, Cape Coral's population had surged by more than 20,000, fueled by families and investors chasing the dream of a waterfront home. The city's canals and palm-lined streets offered an escape from cramped apartments and high taxes. For many, it was the last affordable paradise left on Florida's Gulf Coast. Phones in real estate offices rang non-stop. Agents fielded calls from buyers in New York, Illinois, and California, some desperate for a backyard, others for a tax break, all eager to lock in a deal before prices soared higher. Many offered cash, hoping to leapfrog the competition. Some never saw the homes in person, relying on video tours and Google Maps. A modest 3-bedroom that fetched $240,000 in 2020 now commanded $430,000, sometimes with a dozen offers stacked on the kitchen counter. The median sale price shot up 83% in just 2 years, the steepest climb in Florida. Sellers seized the moment, setting strict deadlines for offers and refusing to entertain contingencies. Inspections were waived, appraisals shrugged off. Bidding wars erupted over houses with faded paint and overgrown lawns. One agent remembers a home with a leaky roof, drawing the 22 offers in a single weekend. The winning bidder paid $55,000 over asking and agreed to close in 10 days, sight unseen. In these frenzied weeks, the typical listing lasted less than a week before vanishing from the market. The newcomers arrived in waves. Retirees from Long Island, flush with equity, snapped up canal-front ranches. Tech workers escaping San Francisco's rents wired deposits from airport lounges. Chicago families, lured by the promise of a pool and lower bills, packed up minivans and headed south. For many, the only way to win was to pay in cash and skip every safeguard. Some buyers never set foot in Florida before closing. Stories spread of investors using hard money loans to scoop up 4 or 5 homes at a time, planning to flip them or turn them into Airbnbs before the paint dried. Construction crews worked around the clock, pouring foundations on empty lots as fast as permits were approved. Permit applications shattered records. Rents climbed alongside home prices, squeezing both newcomers and longtime residents. The city's population, once steady, now felt like it was doubling overnight. For a brief electric moment, Cape Coral shimmered with possibility. The old rules no longer applied. Every open house felt like a lottery, every closing a small victory in a market where everyone wanted in before the next price jump. Convinced that paradise was running out, permit offices in Cape Coral became the busiest desks in Florida. In 2021 alone, the city processed more than 10,000 building permits, a record and nearly double the annual average from the previous decade. Bulldozers and concrete mixers rolled down every major avenue, carving subdivisions from empty lots at a pace that stunned even longtime residents. National builders like D.R. Horton and Lennar snapped up tracts of land, promising new homes in as little as 6 months. Local crews hustled to keep up, sometimes pouring slabs before the morning dew had dried, sometimes framing entire blocks in a matter of days. Developers boasted of fast-tracked projects and streamlined approvals. Cape Coral's planning department, under pressure to meet demand, cut red tape and waived some requirements for new subdivisions. Permit logs from 2021 and 2022 show a flood of applications. Nearly 7,000 for single-family homes, thousands more for pools, docks, and accessory units. Construction cranes dotted the skyline, and the sound of nail guns and saws became the city's new soundtrack. Governor Ron DeSantis seized on the building frenzy, holding press conferences in front of freshly paved streets and half-built homes. In a 2022 speech, he called Cape Coral the future of Florida, praising the city's growth as proof that his economic policies were working. "People are voting with their feet," he declared, "and they're choosing Florida." His administration touted job creation numbers, highlighted surging property tax revenues, and ran campaign ads featuring drone shots of sprawling new neighborhoods. State officials pointed to Cape Coral as a model for post-pandemic recovery, contrasting its boom with sluggish growth in other states. Behind the scenes, some city inspectors raised concerns about the pace. Anonymous tips and internal memos, later cited in local reporting, described rushed site visits and mounting backlogs. One inspector estimated that in the busiest months, he signed off on up to 20 homes a day. Builders, eager to close deals, sometimes pushed for final approvals before all punch list items were finished. Trade contractors cycled between jobs, juggling deadlines and supply shortages. The city's own records show that by late 2022, median days to permit had dropped below 10, less than half the pre-pandemic average. For a moment, the optimism felt boundless. Cape Coral's skyline filled with new roofs, fresh sod, and the promise of endless opportunity. Politicians and developers shook hands at ribbon cuttings, cameras flashing. But as the city sprawled outward and the rush for new homes intensified, questions about long-term quality and oversight began to surface. Concerns that would become harder to ignore when the boom faded. A study from Florida Atlantic University sent up the first red flag. The average home in Cape Coral was selling for 70.43% above its long-term pricing trend. That meant buyers were paying nearly $178,000 more than what historical fundamentals suggested was fair value. Chart after chart from housing economists showed the same pattern. Prices had rocketed so far above the trend line that the gap looked like a cliff face. Incomes didn't keep pace. By late 2022, the typical household in Cape Coral needed to spend more than 45% of gross income just to afford the median home, a figure that left affordability models blinking red. Market analysts mapped the numbers against other boomtowns across the Sun Belt. Nowhere else in Florida, not even Miami or Tampa, showed such a sharp deviation from the long-term average. The data told a story of runaway optimism. In 2021 and 2022, speculation had driven prices to heights that even seasoned realtors struggled to explain. For every new arrival flush with cash, there were 10 locals watching the dream of home ownership slip out of reach. The price-to-income ratio, a classic measure of housing froth, soared to levels last seen before the 2008 financial crisis. National housing researchers flagged Cape Coral as one of America's most overvalued markets, an outlier in both scale and speed of escalation. Listing services reported that more than half of all homes sold above asking price, often with multiple bidders and zero contingencies. The lines on the graphs bent upward, then broke away from every previous cycle. For a while, the euphoria drowned out the warnings. But analysts at Florida Atlantic and other universities began sounding alarms in published reports and conference calls. Their models pointed to a growing risk of correction, especially if borrowing costs rose, but migration slowed. The data was clear. Cape Coral's real estate market had lost touch with economic gravity, setting up a test of just how far fundamentals could be stretched before snapping back. Tax bills arrived like a second wave, catching homeowners off guard. By early 2023, Lee County mailed reassessment notices showing property taxes up 20% or more, sometimes climbing by $1,500 in a single year. For families who stretched to buy during the boom, the numbers didn't just sting. They threatened to upend months of careful budgeting. A Cape Coral couple, both teachers, opened their letter to find their annual bill had jumped from $4,200 to nearly $5,100. Their mortgage servicer recalculated escrow, raising the monthly payment by over $70 overnight. Stories like theirs echoed across the city. Middle-aged homeowners who bought in 2021, expecting stable costs, now faced a squeeze from every direction. Lenders began to scrutinize new applications more closely, wary of rising taxes and the risk of deals falling apart at the closing table. Buyers who once rushed to sign contracts started backing out, spooked by the prospect of ballooning costs. Escrow officers reported a surge in failed deals, some buyers unable to qualify after taxes were updated, others walking away when they saw the new numbers. The domino effect rippled through the market. Local banks tightened lending standards, demanding higher down payments or proof of extra reserves. Agents who once promised quick closings now spent hours explaining tax assessments and recalculating affordability for would-be buyers. For longtime residents, the shock was personal. Many had watched their neighborhoods transform overnight, only to find themselves priced out by the very boom that brought new neighbors. Pensioners on fixed incomes, single parents, and small business owners all felt the pinch. Some dipped into savings to cover tax hikes. Others listed their homes, hoping to cash out before the next bill landed. The affordability crisis wasn't just a matter of sticker shock. It was a slow grind, eroding confidence and putting home ownership further out of reach. And as the market cooled, the next blow, soaring insurance premiums, was already on the horizon, threatening to push even more households past their breaking point. Insurance renewal season arrived with a thud. Mailboxes filled with thick envelopes stamped with policy numbers and bold red totals. For retirees on fixed incomes, the shock came in the form of a single page. Last year's $2,200 premium, now $6,100. Due in 30 days. A couple on Southeast 28th Street, both in their 70s, opened their renewal to find their waterfront home now cost more than $8,000 a year to insure. That number didn't include flood coverage, just the basic protection needed to satisfy their lender. For decades, their policy had climbed in manageable steps, a few $100s at a time. Now, the increase outpaced their monthly Social Security checks. Agents fielded desperate calls from longtime clients. "Is this a mistake?" one asked, reading off a quote that had jumped 180% in 12 months. The answer was always the same. It's not a typo, it's the new normal. The exodus of national carriers, Farmers, United Property, and others, left the market to smaller companies with higher rates and stricter rules. New policies came with demands for roof inspections, 4-point reports, and exclusions for anything that might look like deferred maintenance. The numbers told their own story. By early 2024, the average homeowner's policy in Lee County hit $6,000, 4 times the national average. Families who stretched to buy during the boom now faced a second squeeze. A $400,000 house that once cost $1,700 a year to insure now demanded nearly $5,000. Waterfront homes, always more expensive, soared over $8,000. And that didn't count flood insurance, which FEMA recalculated upward after recent storms. Some residents tried shopping for new coverage, only to find every door closed. Others turned to agents who specialized in last resort options, chasing quotes that changed by the week. A handful dipped into savings, paying premiums with credit cards or retirement withdrawals. One couple, both teachers, watched their insurance bill and property taxes eat up nearly half their take-home pay. They debated selling, but with the market cooling, offers came in below what they owed. For many, the insurance bill was the final straw. Stories spread of neighbors forced to cancel policies, risking foreclosure. Some gambled on going bare, hoping the next hurricane would spare their block. The sense of security that came with homeownership, already battered by rising taxes and falling prices, now felt like another casualty. The affordability crisis had grown teeth, and for thousands in Cape Coral, the dream of paradise was slipping out of reach, one renewal notice at a time. Citizens Property Insurance Corporation, once a safety net for homeowners turned away by private carriers, ballooned into Florida's largest insurer almost overnight. By mid-2025, citizens counted more than 782,000 policies across the state, up from just 450,000 6 years earlier. Lee County alone held nearly 90,000 of those policies, with Cape Coral accounting for over half. That meant 1 in every 5 homes in the city now relied on a state-run insurer, pooling risk not just among neighbors, but across all of Florida. The numbers behind Citizens tell a story of mounting exposure. Total insured value in Lee County exceeded $30 billion by 2025, with Cape Coral's waterfront and canal front homes representing the lion's share. Most of these policies covered wind and hurricane damage, the very perils that had driven private companies to pull out. Yet despite the growing risk, state law capped Citizens' annual premium increases at 14%, a political compromise that kept rates below what actuaries said was necessary for true solvency. Internal memos circulated among state legislative aides and Citizens executives warned that this glide path, while popular with voters, left the insurer underpriced in the riskiest neighborhoods. Citizens' financials looked solid on paper: $1.64 billion in cash and investments, $2.6 billion in annual premium, and a web of reinsurance contracts meant to absorb the first shock of a major storm. But actuarial reports submitted to Tallahassee told a different story. In the event of a direct hit by a Category 4 hurricane on the Gulf Coast, a scenario modeled after Hurricane Ian, Citizens' own reserves and reinsurance would fall short. Loss projections for Lee County alone ranged from $7 to $12 billion, far beyond the insurer's ability to pay claims without outside help. That's where the mechanics of taxpayer exposure come into play. Florida law gives Citizens the authority to levy assessments on all property insurance policyholders statewide if its surplus is wiped out by a catastrophic event. The regular assessment can reach up to 15% of a policy's premium per year, with emergency assessments adding another 10% annually for as long as needed to cover the shortfall. In practical terms, a single devastating hurricane in Cape Coral could trigger multi-year surcharges on every homeowner's insurance bill from Pensacola to Key West, even for those never touched by the storm. Legislative aides in Tallahassee have grown uneasy with the scale of this risk. Internal emails and committee hearing transcripts reveal concern that Citizens' exposure, now topping $525 billion statewide, is outpacing both reinsurance to capacity and political appetite for future bailouts. Efforts to depopulate Citizens by forcing policyholders back to private insurers, if comparable coverage is offered, have stalled in high-risk coastal zones, where private rates can run 20 to 50% higher and offers are scarce. Statute requires Citizens to transfer policies when possible, but in practice, the riskiest homes remain stuck, unable to find a private carrier willing to take on the gamble. For state lawmakers, the actuarial math is sobering. Reserve levels, while robust by historical standards, are dwarfed by the potential for multi-billion-dollar losses in a single season. Catastrophe modeling, updated each spring, shows that a 1 in 50-year storm hitting Lee County would leave Citizens unable to pay all claims without resorting to assessments or, in the worst case, state-backed borrowing. The last time Florida imposed such assessments on all policyholders was after the 2005 hurricane season. Today, with exposure tripled and reinsurance markets tightening, the risk has only grown. The implications ripple far beyond Cape Coral. As Citizens' enrollment swells and its reserves are stretched, every Florida homeowner becomes a silent stakeholder in the next big storm. The state's actuarial memos and legislative debates point to a system where the cost of paradise is quietly socialized, and the bill for one city's disaster could end up on the doorstep of millions. Home values in Cape Coral, once a badge of pride, became a source of dread almost overnight. By summer 2025, the median sale price had dropped 11%, erasing nearly $40,000 in equity for the average homeowner. For families who bought at the peak, the numbers didn't just sting. They upended plans for college, retirement, or even a second child. A young couple on Southwest 17th Place, who stretched to buy their first home in 2022, watched their down payment vanish on paper. they'd hoped to refinance and start a family. Now, with their mortgage underwater, every option seemed out of reach. Investor pain ran deeper. Hard money loans, once the ticket to quick riches, turned toxic as prices fell. Court filings in Lee County show a New York investor defaulting on a $2.3 million loan after failing to sell a portfolio of 5 homes, each now worth less than the original purchase price. Lawsuits piled up, contractors suing for unpaid work, lenders chasing missed payments, and municipalities citing abandoned properties for code violations. Local property managers, who once fielded calls from Airbnb hopefuls, now spent their days chasing late rent and fending off eviction notices. Landlords who banked on endless demand faced a harsh new calculus. Rents, which had soared during the boom, began to soften as inventory flooded the market. Vacancy rates in Cape Coral reached 9% by mid-2025, the highest in a decade. Some owners slashed rents to keep tenants. Others listed properties at a loss, hoping to escape before the next tax bill arrived. The ripple effects stretched beyond single-family homes. Apartment complexes reported rising delinquency, and rental assistance programs saw applications double in 6 months. For many, the crash was more than numbers on a spreadsheet. It was the sound of postponed weddings, canceled vacations, and retirement dreams put on hold. Parents told children they'd have to wait for new bikes or birthday parties. Neighbors who once swapped renovation tips now traded stories of lost savings and legal threats. The city that had promised a fresh start became a lesson in fragility, as the fallout from the bust seeped into every corner of daily life. Cable news anchors, local columnists, and national correspondents all zeroed in on Cape Coral as the headlines shifted from boomtown to battleground. In July 2025, the governor called an emergency press conference flanked by state housing officials and insurance regulators. Cameras captured the moment his tone switched from celebration to alarm. "We are facing a housing emergency in Cape Coral," he declared, voice sharpened by frustration. "This is not just a market correction. This is a threat to the stability of our communities." Within hours, his words ricocheted across social media and talk radio. Political analysts dissected every phrase, questioning whether state policies had fueled the crisis or simply failed to contain it. Editorial boards ran pointed headlines: "Paradise Lost," "Florida's Boom Goes Bust," and "DeSantis Faces Reckoning in Cape Coral." Reporters pressed for answers on the insurance collapse, the wave of underwater mortgages, and the surge in inventory. The governor's office released a flurry of statements promising new legislation, faster disaster relief, and talks with insurance executives. Behind the scenes, aides scrambled to coordinate messaging with lawmakers and industry groups. Leaked memos revealed deep concern about the optics of families losing homes, while state reserves sat untapped. On the Sunday morning circuit, the governor defended his record, blaming global inflation and federal interest rate hikes for the downturn. "We built an economy people wanted to move to," he insisted on national television. "But Washington's policies have driven up costs and scared off investment." Still, fact-checkers pointed out that local tax hikes and insurance premiums, set by state and county decisions, played a bigger role in the squeeze. Journalists highlighted the disconnect between the governor's earlier boasts and the current distress. Quotes from his 2022 campaign ads, "Florida is open for business," and "Cape Coral is leading the way," were replayed alongside footage of foreclosure signs and abandoned construction sites. Political commentators speculated about the fallout for his national ambitions, noting that swing districts across Florida now face similar housing pain. Public frustration boiled over at town halls and online forums. Residents demanded relief, some calling for property tax freezes, others for direct aid to underwater homeowners. As the debate intensified, the governor's every move drew scrutiny, not just from the opposition, but from his own party, worried about the political cost of inaction. The spotlight, once a badge of pride, now burned hot as the next hurricane season approached, threatening to turn policy missteps into a full-blown crisis. Insurance companies across Florida moved quickly as the first hurricane watches were issued for the Gulf Coast. Within hours, binding restrictions landed in inboxes from Tallahassee to Miami. No new policies, no coverage increases, no exceptions for last-minute buyers. Citizens Property Insurance, now the state's largest carrier, activated its contingency teams and halted all new business in counties under threat. Private insurers followed suit, freezing applications and instructing agents to suspend quotes. The state's Office of Insurance Regulation circulated bulletins reminding carriers and the public that binding moratoriums were standard procedure, not optional. Mortgage lenders and title companies responded in kind, putting real estate closings on ice wherever insurance binders could no longer be issued. For buyers on the brink of closing, deals stalled with a single email. Agents fielded anxious calls from would-be homeowners, some already packed and ready to move, told they'd have to wait until the storm passed and properties could be re-inspected. In Cape Coral, the pause rippled through every corner of the market, exposing just how dependent the region had become on the constant churn of new deals and fresh coverage. The system, built on perpetual motion, now stood still, waiting to see what the next storm would bring. Escrow accounts in Cape Coral sat frozen as hurricane alerts swept across the Gulf. Title companies sent out mass emails, closings delayed, sometimes indefinitely. Real estate attorneys fielded frantic calls from buyers and sellers caught mid-deal, their contracts in limbo while insurance binding restrictions locked the system tight. In Lee County, thousands of transactions paused overnight. Mortgage lenders refused to release funds without proof of active coverage, and insurers wouldn't bind new policies until the storm threat cleared. Some buyers faced rate lock expirations. Others watched moving trucks idle in motel parking lots, their plans on hold. For sellers, every day of delay meant another mortgage payment, another insurance bill, another chance for the deal to fall apart. Escrow officers reported delays stretching up to 30 days, with funds trapped and signatures waiting for a green light that never seemed to come. In this standstill, the market's fragile rhythm broke. The churn of new deals, once the city's economic pulse, fell silent, leaving everyone to wait and wonder what would be left when the clouds finally passed. By 2025, Cape Coral's median home price had fallen 11% from its peak, while inventory surged over 50% and 8% of local mortgages were underwater, the highest rate in the country. The documentary has shown how a pandemic boom, fueled by migration and speculation, gave way to a sharp reversal as interest rates, property taxes, and insurance premiums soared. More than 1.4 million Floridians were forced into Citizens, the state-run insurer, concentrating billions of dollars in hurricane risk. Despite Governor DeSantis's public statements and emergency measures, the long-term stability of Florida's housing and insurance systems remains in question. Key documents on insurer solvency and legislative reforms are still pending release. As new threats like severe storms loom, Cape Coral stands as a cautionary example of the risks of unchecked growth and fragile protections. The consequences of this bust are not just local. They challenge the entire state to confront its vulnerabilities with urgency and transparency.